Welcome to the bathtub, everybody. Yes, I am Buck, you know what, and I'm loving it. So in this video, we're going to do a quick critique of the three fund portfolio that's put out there and shilled by the Bogleheads. And yes, I don't 100% agree with the Bogleheads, okay? Sometimes I think they're wrong. You know who's never wrong? Me. So what is the three fund portfolio? Well, it's a very simple asset allocation strategy where you put a portion of your investments into a total market US fund, a portion of your investments into a total market international fund, and then you put the rest into a total market bond fund. And you jiggle around that three fund portfolio based on your time horizon. Now, a lot of people are buying bonds right now. Well, some people are, obviously, because rates are higher. But, over the past couple of years, all I've heard is bonds are trash, bonds are this, you don't need bonds, just buy 100% stocks, bro. Dave Ramsey, all the clowns out there. I do think at some point you need bonds. And the reason I think you need bonds is for stability. It's for a guarantee that you're going to have a certain amount of money at a certain time. Stocks are very, very volatile. Okay, stocks can go up very fast and they can go down very fast. So if you need money in a year or two or three, do you want to put it in stocks? Maybe you put it in stocks and it goes up a lot and then you make money. But if you need the money and then the stock market goes down, which is very possible in a 3-year time horizon, 4 years, 5 years, there's plenty of times that stocks have gone down for a long period of time. You are going to be in a world of hurt. You're going to have to sell at a loss. So if you absolutely need money at a certain period of time, you need to either take a gamble with stocks or try to guarantee as close as you possibly can to being able to have that money. Now, here's where I think the three fund portfolio fails. So let's say you're about to hit retirement and you're like, man, okay, well, I'm about to retire. So I'm going to be 60% stocks and I'm going to be 40% bonds, which I don't have a problem with that, as long as you don't put it into clown stocks and clown bonds. But I do have a problem with the bond element of the ETF. So how I envision it is the stock element of this portfolio is there for long-term growth. You're going to be retired for 30, maybe 40 years, and you still need your money to grow. Okay, you can't just be all bonds, especially with inflation over 30 or 40 years. You still have a very long time horizon in retirement if you live that long, which is possible for a lot of people. And then you have the bond element, which is there for stability and to be able to pull money out. So let's think about this. If you put your money in BND, which is the bond ETF that all the Bogleheads shill, can that go down? Yes, it can. Because there's this thing called interest rate changes. And when interest rates go up, bond prices go down. And when interest rates go down, bond prices go up. It's a present value calculation. That's all it is. When you change the market rate, you discount the future cash flows at a higher discount rate, which means the bond's value goes down. Basically, if interest rates go up really fast, long-term bonds, the longer the bond, the faster it's going to drop. Go look at the TLT ETF. And you'll see what happened when interest rates went up just a couple percentage points. It got wrecked. Go look at BND. Look at BND from about the end of 2020 to now. And look how much that ETF has fallen. It's fallen, what, 20? I think it was like at the peak of roughly $90. And now the total bond ETF is like $70-something. That's a pretty significant decline in 3 years, even with interest distributions, even with interest payments. And if you think about it, why would you want just BND? If you need money in a year or two, what would have happened to you had you held BND and the market dropped, the bond ETF dropped 30%? You'd still be selling at a loss. It doesn't make sense. So instead of a BND can belong in a retirement portfolio, but you need money in other things that are basically as close to guaranteed as you possibly can get that aren't going to fluctuate a lot in value, like a certificate of deposit, okay, not at a clown bank, a savings account, maybe a very short-term treasury ETF. Those don't fluctuate. Okay, go look at SGOV, SGOV ETF, short-term Treasury ETF. That thing does not fluctuate. I mean, you'll see the oscillations, but that's because of interest distributions. But if you look at the total price swings, it really doesn't move that much because it's a short-term bond ETF. You need that in your port. You can't just have BND and VT. If you had listened to a lot of people that shill that, oh, you just need BND and VT, it's easy, bro. And it was 2020, 2021, you got your cheeks clapped because the stock market went down and bonds went down. It's crazy because when interest rates are zero and then you raise interest rates, it really is an everything bubble. You raise interest rates, the risk-free rate becomes higher, that increases the discount rate for valuing stocks. That makes companies' cost of capital more expensive because debt's higher, the risk-free rate's higher, stocks drop, and bonds drop. And the BND ETF is no exception. Just because it's a bond ETF doesn't mean it's safe. So you really got to think for yourselves. Okay, I'm not just going to have BND in retirement. I'm probably going to have like CDs, SGOV for shorter term money needs. Maybe BND will be in there somewhere. But for the love of God, you should not have all of your bond allocation in BND if you're trying to withdraw from that in retirement, because there are scenarios like we just saw where everything can go down and then all that money you saved, you're going to have to sell all that stuff at a loss. A lifetime of savings gone because you had a crappy portfolio. Be careful out there. Cheers.